All right, we got about a minute and a half until we kick things off for this week. Thank you for those of you who are patiently waiting. All right, and that is the timer. So let's jump into it. Let me exit out of the notification, and we will kick off another weekly stock market scan. We had been slacking, over the past month, but this is 2 weeks in a row, so we're back on the horse. Love to see it and happy to talk about it because the past week for us, and really the past month, has been very, very profitable. Last week we took home a profit of $3,412. And we did underperform the market slightly as the S&P 500 went up 2.6% and our account only went up 2.17%. But if there were a type of underperformance that we'd like to see, it's definitely this where we're still making money. Because technically, with all of these trades that we enter into, we have defined risk and defined gain, which I view as a feature. When we have defined gains, sometimes the S&P 500 can run a little bit hotter than what we can potentially collect in gains, but that's all right, because any week that we have a winning week is a good week, to be honest. And if you go to our year-to-date summary, this tab loads for me, we're actually up. This is this next week, so it's just these 3 weeks, but we're up $17,722 so far in July, which is about a 12% return compared to the 3.63% return of the S&P 500. And really, since May, we have just been dominating the S&P 500. Back in May, we returned 6.77%. Despite the S&P 500 returning less than 1%. In June, we dropped a couple of percent, but that was in the face of an 8.19% drop on the S&P 500. And in July, we've got almost a double-digit lead on the S&P 500 from a percent return perspective. And you'll see the chart right here. This is really the only chart we care about because, as I've said before, we could finish an entire year losing money, but as long as we do better than the S&P 500 and the NASDAQ, right, the overall market that we're using to benchmark our performance, I would consider it to be a success. So here's our chart right there. And as you can see, we were underperforming for a little bit at the beginning of May, but we have gotten off to a strong lead and most importantly, performance since we started publicly tracking our trades back in 2020. We're outperforming NASDAQ by over 100%. We're outperforming the S&P 500 by a little over 90%. So long-term success is what we look for in the strategy. Long-term success is what we've accomplished so far, and it's only been, I guess we just crossed the 2-year mark for publicly tracking our trades, so we've got a little bit of a history behind us. But 2 years is nothing compared to like a 5, 10, 15, 20-year investment outlook. So we're gonna stick with it and keep things moving. But top to bottom, we actually did have a lot happen last week, and I think there are some good lessons worth talking about. In general, the market went up, so our long positions performed pretty well. DraftKings took home a profit of about $1,900 for us. Opendoor, MSOS. You go a little bit further down here to see Lemonade, Unity, Snapchat. I guess that wasn't really a beginning of the week trade, but Fubo and SoFi, those cleaned up as well. That kind of powered our portfolio. But we did run into a little bit of hot water with the spreads that we opened between the SPX spreads and the MARA, M-A-R-A, spreads that we opened. You'll notice spreads have actually been doing really, really well for us. We're up at about almost $10,000 of profit on the year on spreads. The past few weeks, right? 2 weeks ago, we took home $1,300. The week before that, $1,100. $1,300 the week before that. Lost 35, but you really have to go back pretty far on the profit tracker, right? We've got to go all the way back to the week of May 15th, to the last time we actually lost a decent bit of cash with these spreads. So all that to say, the spreads have been a fantastic approach for us so far, and we're happy to continue to mix those in. But we did face a little bit of adversity with those spreads, and we'll talk about it. And the majority of that came with Mara, and if you highlight all of the Mara trades we entered, it's a $1,130 loss, which you never want to have. But outside of that, we made money, right? Our SPX spreads, even though they ran against us very, very hard, we still made money there. So a lot of good lessons to be learned from those. With Mara, we could talk about that one very, very quickly here. If I pull up the chart, we can kind of tell the story of what happened with that trade, how we decided to manage it, because it did get a little bit convoluted. We had the idea of potentially getting into naked calls at some point and breaking off part of our spreads. But let's just pull up the 5-day chart here to briefly talk through that one. Right, so when Mara broke up, above this $9 level, we initially entered with, where's the position? Yeah, 10-12 strike, or 10 short leg, 12 long leg, 10-12 call credit spread, meaning a bearish position, where if Mara finished below 10, we'd hit max profit of $320, which we thought was we thought were decent odds. On the 5-day chart, it may not look like that. But if you go back to the 20-day, keeping it below this level seemed relatively realistic. Unfortunately, it kept running up and got as high as basically tripling over a 10-day period, which with these volatile stocks, I'll be the first to tell you that that's just going to happen sometimes. However, we need to be able to manage it, right? And that's what we try to do. We added some 11-13s. So our initial break-even price off that 10 short leg was 10.32, the 10 short leg plus the 32 cents of premium. And then adding these bumped up our break-even price by 42 cents, giving us a 10.74 break-even price, which was decent, especially considering we started the trade at 9.50-ish. However, the market can remain irrational longer than you can remain solvent is a very famous quote, and one that I think rings true way more often than not in the market. So it had other plans it kept running through. And as you can see, we ended up closing both of these out for losses. So that's $1,700 worth of loss on those initial spreads. And you'll remember that overall, we lost $1,100 on Mara. So outside of these initial two, what we did to manage after made us back $600 and kept things manageable. So our initial plan, and I think I actually have this, my insane idea here, was to break these things up, right? We had these trades and potentially would take on a short position. But the idea here was that we would separate the spreads, right? Because every spread, especially called credit spreads, have one short leg and one long leg. And when they move against you very dramatically, yes, your overall position is at a loss. However, these long legs that we're in are actually at a gain, right? So we could have closed those out respectively for $27.80 of profit, and that's what we did. And then let the naked calls essentially ride, let the short legs of those ride. And those were at a decent loss at one point in time, and this is a hypothetical based off of if Mara went to 16. I think it was at about 13 when we were considering all this, or maybe 14. But the idea here is, yes, you have this $4,400 loss. You could lock in $2,700 worth of gain, and then you could put yourself in a position where if these fall back down and Mara goes down to like 12, all of a sudden you've locked in profit here, and then all of a sudden you get profit on these short calls as well. To give yourself almost a total profit of $4,150. And then to further hedge that, as you can see here, indicated by the word hedge, we had 12.5 strike puts. So if Mara did keep going up to something like 16, and these the naked calls lost a little bit more money, we'd at least make $1,800 back off of the long 12.5 cash secured puts. And funny enough, like max profit on this little idea here is if it went to 12.5, we would have made $4,650 on the trade. And Mara at the end of last week finished at 12.42, meaning that if we had gone through with this and it finished at 12.42, that $1,100 loss that we showed on the other tab would have actually been a $4,500 gain. But, ifs don't really count in the market. This is just the idea that we had. However, the reason that we did close out so quickly after doing that is because Mara dropped right back down. We locked profit in right here, and we were able to almost get out for break even on these. So we figured all in all, if we had a stock basically triple on us in a 10-day period, that's not going to happen very much. But in those instances, when it does happen, if we could limit the damage to something like $1,100, that's going to be okay, and that's how we're going to succeed in the long term. So that was really our big loser on the week. SPX got very, very dicey, and the SPX 0-day call spread is something that we've been talking a lot about lately because it's been a very, very profitable strategy for us. if we flip over to our SPX tab, since the beginning of May when we've been starting to run this, we have about $7,000, I guess not about, it's exactly $7,000 in total profits off of these SPX spreads. And yeah, good comment. Most of the screen's not being used. I could definitely zoom in a couple clicks for you. Hopefully this makes it a little bit easier to read for you guys. I do share screen on a pretty big monitor, so I can lose sight of what it looks like if you're just watching it on a regular laptop or your phone. So appreciate the comment. Definitely let me know if there are any visibility issues in the future. But yeah, these are the SPX spreads that we've been running since the beginning of May, and we choose the beginning of May because that's about the time frame that the 0-day SPX options have been introduced, right? Because we know now that SPX has option expiries Monday, Tuesday, Wednesday, Thursday, Friday. That did not used to be the case. But since they've added those Tuesday and Thursday expiries to give you 5 days a week of option expiries, there's a lot of flexibility and opportunity for profit here. And it wins a lot, right? We have just on the individual spreads that we're running right here, it's 72.55% success rate. So the actual spreads themselves are working very, very well. And on this little tab, I guess further up here, all we need to have this expected value, right, where we can expect a 5% return, and if we ran this 1,000 times, we'd make 60 grand. We only need a 67.5% success rate for all of this math that we see right here for these hypothetical long-term results to play out. If we maintain something like a 72.55% success rate, and this is 27% chance of failure, we basically have an 11.26% expected return on risk for every individual spread that we open, which is an insane number. Now, again, sample size is pretty small, so we're going to keep the math conservative with a 32.5% chance of failure on the first one. But, we like the way these things are trending. And you've seen a lot of green on this lately. I think we had hit like 12 of 13 spreads at one point for a decent bit of profit. But last week we finally, I guess, had one turn against us. And it's great that that happened, not because we like losing money, but it's good because it's super easy to open these over and over and over and over again and take $300 day after day after day after day. The skill with these 0-day SPX spreads and really skill with any strategy in general is being able to manage it when things turn against you. And that's exactly what happened. So if we go take a look at SPX, it was actually kind of insane. So let's take a look. Especially when we look at this over the last 180-ish days. Actually, 20 days perfectly fine. We kind of had been trading in this 3,900 to 3,700 range, bouncing up and down, bouncing up and down. And last Monday we had a decent bounce, or we had a decent dip, so it looked like we were heading back down to that 3,700 range again, potentially. However, we had 1, 2, 3 days in a row of green, and it wasn't just green, it was a huge amount of green, right? We went from 38.31 at the end of the day on Monday, and we actually breached 4,000 on Friday, which is an insane jump in the market, as indicated by the fact that RSI got into the red here, indicating that the market was very, very overbought. But with that said, we were playing it bearishly this day, this day, this day, and this day, this day, this day, and this day. We actually played it bearish every single day of the week. And despite the fact that we had 5 bearish SPX spreads, if I can go back to our profit tracker tab, despite the fact that we had 5 bearish SPX spreads, meaning we were betting on it to go down, and the market went up 2.6%, we still made money on SPX during the week. We still turned a profit of $180. So not only was last week kind of a disaster type situation because we had the market move against us and we had to double and triple down, it actually ended up profitable despite going terribly against us. Monday and Friday worked well. I will give it that. However, Tuesday, Wednesday, Thursday were really, really tough. And a good example of what we were potentially looking at here, or I guess it was about the biggest loss we've had to take, right? Because we had 1,300 or 1,400-ish of losses after the first 2 rolls. And then again, we double down. We go from 3 to 6 to 12. And you don't have to start with 3. You could start with 1 and go from 1 to 2 to 4. Either way, though, this is the strategy that you follow in order to get these expected value odds up here. And if you have any questions about this strategy, we do have a blog post on our website, hourglass-trader.com, detailing this strategy and how it's been so successful over the past couple of months for us. But with that said, it's really tough to separate the emotion from trading here. I admittedly on Thursday, I think I made the comment at the end of the day on Thursday that I felt like I was exhausted. Because staring at SPX as it continues to move against you, where we had this 4,000 short leg, and we watched it just go up and up and up, and it finished just, like if we zoom in here, it finished just below 4,000. So we barely did it, but we did hit max profit, and then we continued our bearish trades, and that's what drug us to an SPX profit on the week. But point being, these SPX spreads, while they can get a little dicey on a day-to-day period, it's important to take emotion out of the trade, follow the process, double down, roll up, roll out, and keep it moving. Because eventually the math will work out. Sometimes we are going to have bigger losses. I'll be the first to tell you that. But a lot of the time, it's going to work out for us. And we have those percentages conceptualized further up on this tab, right? The probability, and technically after 3 rolls, it was supposed to be a $420 loss. We only ended up with a, let's see what that was. $405 loss. Okay, so right, about right on the money. But again, the probability that that happened to us was roughly 7%. So that will happen. Don't get me wrong, that'll happen. But it's far more likely that we hit on the first trade or we hit on the second trade, both of which result in profit. So that worked well for us, even though it was a very, very, very stressful little situation there. And I got to be honest, I don't get stressed out too much in the market because I think everything we do is very, very manageable. But that was something that popped up there. And our new trades, because they were weighed down a little bit by Mara, actually lost us a little bit of cash on the week. We did play some Carvana covered calls. We talked a little bit about the Mara, not covered calls, excuse me, call credit spreads. We talked a little bit about the Mara call credit spreads where the price kept going up on us, so we added again. With Carvana, the price kept going up on us, so we added again. And that resulted in us, we eventually got chased out of the first spreads because I don't really like holding spreads the day of expiry, with the exception of XPX. But the second ones that we entered, they were a breeze. So we took 250 home on that. We did lose 100 on the first spread, but hey, that nets out to $150 of profit. And I get, excuse me, and if I can make $150 of profit per spread that I open, we're going to be very, very successful long term. Affirm. This one would have been max profit, but again, to the point of not being a big fan of holding spreads the day of expiry. We had these on Friday, and we dumped them for about even money. And the reason we did that is because 30 was the short leg, meaning on Affirm, if we kept it below 30, we were going to hit max profit. We had the opportunity to close for a 55-cent credit, and then rolled it next week for a 51-cent credit. So you lose about 4 cents in the process, but we were able to roll the short leg up to 32. So instead of the previous week where our target was 30, we now have a target of 32 to keep the stock below. And it actually, if we look over here, Affirm finished up last week at 26.77. So these should cruise next week. And if Affirm does open a little bit lower, I'll probably close them for a couple cents just because there's so much that can happen in the market on a day-to-day basis that we just want to be careful. And the number one thing that we can do is protect ourselves. So closing trades on Monday or Tuesday that have substantially realized just about all of their profit is a very, very smart move, especially because there's a very important event this week with the FOMC. The Fed is going to be announcing the rate hike for the end of July here. And then we also have some pretty big hitters announcing earnings. So a lot of potential for things to swing the market one way or another. And with that said, talking about these SPX spreads, I would not want to hold any SPX spreads overnight. That is very, very risky because you leave yourself subject to if Apple has a bad earnings and you had a bullish put spread that you were holding overnight, that could tank the market. But just a lot of different things, and I'm expecting a lot of volatility, which is why the list of trades we have for next week is a lot shorter than what we saw last week. And then maybe last thing that I want to point out here that's noteworthy on our recap for last week is ATUS right here. And I think this one was actually a phenomenal trade, and it was alerted in our Discord server via the stock halt alerts that we have. Where's the old Discord server? Pull it onto the screen really quickly, right? So for those of you who are our premium members, we've got the stock halt alerts that show up in this channel. FFIU is on there. We made some money off that as well, but there's ATUS alerted. I believe that was Thursday morning, but it was halted. And usually when we have big halts like that, the key is to look and see if it has options, and everything alerted in that channel does have options, so we do some of the work for you there. But what we were able to do was take a look at ATUS, and this is kind of a classic option scalping chart for people who sell options. right? So you see this big green candle and has a big spike in implied volatility. When you see those two things, you want to, one, check what the news is. Why is there a big green candle? And it's because they were takeover rumors, which is fantastic. And then two, you want to see where it took off from. So it was trading at about 9 before it jumped, but it had established a low of about 8-ish a share. So I didn't really want to sell quite at 9. I wanted a little bit more of a cushion. And thanks to this big spike in implied volatility, which eventually came back down, we were able to sell 8 strike puts for 40 cents. And before the end of the day, we got out of those for 20 cents. So that was $200 of profit just off of one quick little alert in our Discord server. And it's why I always say I'm always happy to teach people for free. If anyone is in the Discord server and has questions, throw them in beginner questions. I'll always be checking on that to answer. But if you do want to take your trading to the next level and use some of these tools that we're using to identify our trades, especially the time-sensitive ones like this, head over to hourglass-trader.com. You can sign up for HT Premium, but that is enough of the self-plug. Let's talk a little bit about what we've got coming up the next week, how we're going to make money. It's great that we've had this great month of July where we've taken home $17,000, but that's in the past. Let's talk about what we're going to do this week heading forward the next 5 days in the market. So top to bottom here, we've got Affirm, 25 strike puts. And again, Affirm's one we've kind of been playing week to week to week. You can see we had the 22 strike puts, which bagged us $530. The week before that, we had 22, and then we rolled down to 20, and it bounced back up. That bagged us about $810. Week before that, we got $2,415. So the past 3 weeks on Affirm, we've made over $3,000 off selling puts on it. So we're going right back to the well. And again, one thing that I do want to be clear about is that our full position size on Affirm, as illustrated up here, is 15. And we're only going to get up to 15 contracts if we have to roll down twice during the course of a week, just because the stock has dropped. The game plan for Affirm, and the game plan really with any of these cash secured puts that we're holding on to, is we know that when we enter into a 25 strike put for a $1.06 premium, our break-even price, as illustrated over here, is $23.94. And really what this means, this cushion that it's calculating, is in plain English, as long as Affirm does better than decreasing 10.57% in the coming week, we're going to make money on the trade. And when you have odds like that on your side, it sets you up really, really well for long-term success. And that's what we've seen so far in the market over the past couple of years of our publicly tracked trades. But with that said, how do we manage, right? If we have 5 right now and we know that our full position size is 15 contracts, how do we get up to 15 contracts? And the answer is that we wait. And if Affirm gets below $23.94, we sell 5 more. And if we sell 5 more for $1 premium, that's going to knock our break-even price another $1 down to about $22.94. And then we wait again. And if it goes below $22.94, we add some more, and then you just keep the cycle moving. And the great part, once again, if that never happens and you never even need to lay a finger on the sell button or the close button, you could have a very stress-free week where we don't touch Affirm at all, and we take home $530 of profit. That's the way we like to trade. With DraftKings right here, this one actually behaved really, really well for us. We sold these 13 strike calls last week, and I think at one point, either Thursday afternoon or on Friday morning, DraftKings has gotten up to like $14.50 a share, and it was running away from us a bit because we know when we sell 13 strike covered calls, we limit our potential profit on the shares at that point. However, it fell all the way back down to $13.34, and we were able to roll these, and again, we bought to close for 34 cents, and we sold to open for 75 cents. So it was like a 41-cent credit on the roll, which is a direct reduction to our break-even price, which is now down to $14.24, after we started the trade in November with DraftKings at $36 a share. So despite the fact that DraftKings has dropped 62% in the time that we're playing it, and if we had just purchased shares at that point, we would have lost $45,000. Thanks to our option selling strategies and following the HT wheel process, we're only down about $3,300 on this position. And this isn't even factoring the new cash secured puts the covered calls that we sold, so it's even better than that. So that is why we love this process. We could really handle any type of volatility in the market provided that there's enough premium and that we're comfortable holding the stock long term. DraftKings checks both of those boxes. But for the coming week, we mentioned at the top of the stream, there's going to be a little bit of volatility with the Fed. We've got some big names announcing earnings, a lot of potential for things to swing the market. So if the market does swing down, I wanted to be a little bit more conservative and just hold on to that 13 strike. Because if DraftKings runs away from us again, you know what? That's okay. We get $820 of profit on it. I'm not going to be upset. I'm not going to be upset with that over the course of a week. But if it runs further down, we've got 75 cents of premium protecting us. And again, we've got a 12.59 weekly break even, which is a 7% cushion on DraftKings. So as long as DraftKings does better than dropping 7%, we're going to make money on it. And then we've got some of the familiar names that we talk about. We've got Open Door, we've got Fubo, which are going to bag potentially $170 and $110 respectively. And then MSOS, which we identified from the intersect with feature on our scans that we talk about. And we'll have a video coming this week about using that intersect with feature in your scans, because we've got our option scanning videos on our channel. If you haven't seen those yet, check them out. But they're a great source of where we get a lot of our ideas. And a couple weeks ago, we were kind of out of ideas, so we ran a couple scans. We used the intersect feature, which we'll talk about in the video this week, and we found MSOS. And in the past few weeks, right, where's MSOS? We've got one right here. We sold some more on MSOS the week before that. And I believe we had one more week of selling, we took assignment on some shares. And then there you go. So over the past 4 weeks, we've made $710 of profit off of MSOS. And that's an opportunity that we identified just from about 5 minutes of work on an option scanner, which further hammers home the point of how important it is to know how to scan for options and have an effective option scanning strategy. But we've got it. We're going right back to the well on it again, and we're hoping to add to this 710. We're potentially going to bag another $230 of profit to get us up to almost $1,000 off of MSOS. And then going further down the list, we have a couple call credit spreads, which are bearish positions on Affirm, as mentioned earlier, and on Tesla. Tesla, I didn't think their earnings were stellar. The stock still ran up a ton, and I think it's got room to run back down. But again, on this one, as long as it stays below $875, we're going to take home $400 of profit on that trade. How does that work? With our break even of 876 and Tesla sitting at 816, as long as Tesla doesn't go up 7.26% this week, we're going to make money on that trade. And again, Affirm, we've got an even bigger position at 21.44%. So just really, really happy with how the portfolio is shaping up. The closest thing we really have is Zim at a 4% cushion and gold at a 3.78% cushion. But gold is a much less volatile stock, so that kind of is appropriate for that kind of a cushion. Zim did drop a little bit after we opened it on Friday, so our cushion's a little bit smaller. It was a little bit bigger when we opened it. But again, 4% is still solid, and we're starting off small on Zim. We've got a 10% position size. We're happy to double it down and take assignment in the low 40s. But from there, either way, we're happy to take assignment at a 43.55 basis. And that kind of rounds everything else out, right? We've got Unity, which popped up on our option scanner as well. We actually added that one last week for $384 of profit, and I think that was the first week that we did it. Yeah. But that's what we've got headed into the week. And the way that we, evaluate these trades is stocks can go up, we can make more money. Stocks can go down, we can make less money. But I think objectively, figuring out what kind of premium and what kind of positions you have set up for yourself at the beginning of the week, the best way to identify it is by saying, okay, what would happen if the stock stayed dead flat? And that's what we're looking at here. A dead flat market, we'd take home $3,431, which is a 2.14% return, and would power us to a July where we take home over $20,000 of profit, which is fantastic. And as we continue to try to build our lead of over 100% on NASDAQ and about 92.81% on the S&P 500. So that's what we've got headed into the week. But as we like to do at the beginning of each week, we want to come up with a little bit of a shopping list. And I deleted, I think, what we had last week. But a couple names from that shopping list were Lemonade. And then Snapchat was an opportunity that presented itself after a really, really big earnings decline. But let's come up with a few names because, look, if the market goes up, we're going to make this amount of money, and it's going to be a fantastic low-stress week. We're also going to plan on playing some zero-day SPX spreads, so maybe add 3, 4, 5, 600 more to this total. So we're targeting about $4,000 of profit. And again, as you can see, especially as indicated by the new tag that we have in column G here, we open a lot of trades during the week because, yes, there are good setups on Friday afternoons, but Monday through Friday in the stock market, I cannot emphasize this enough, it is such a long time. And if you go scroll back up, we have got a habit of adding a lot during the week. Like 2 weeks ago, the new trades that we added just during the week took home $2,500 of profit. The week before that, those trades took home $2,000 of profit. The week before that, they lost money. But the week before that, lost money as well. And then 2 weeks before that, $2,000. But point being, I know the answer, and if I add up all the new trades that we make during the week, those are particularly profitable over the long term. So yes, we have this. I'm happy with how we're set up, but let's have a little bit of a shopping list so that if we wake up Monday morning or Tuesday morning or even Wednesday morning and we see that the market's red, which it is kind of on track to be, futures are down 0.30%, but in how volatile this market has been, that's kind of nothing. But let's get some names that we potentially would be happy with adding to our portfolio. So one of the first names that I would add, and I already have it in there, is SoFi, because that's one that we've been playing on a week-to-week basis. We took home $110 from it last week. If we go to the SoFi trade breakout, we just, the week before that, wrapped up a nice little cycle of the HT wheel, where SoFi made us a little bit over $1,000. So SoFi is a ticker that we like, but if we look at SoFi and look at what it did last week and where it's currently sitting, it finished last week at $6.62, and it did drop down 6% on Friday, which would provide a decent entry opportunity. However, we want to keep this 20-day chart in mind. It was down at 514 pretty recently, so 650 isn't quite a strike that I think I'm comfortable with selling, especially because you're only getting about 17% of, or 17 cents rather, of option premium, which would put your break-even price around 630-ish, which is right around here. And the way I like to look at these break-even prices is if I look at the chart and it looks like it's very, very likely that we could break below that break-even price, I really want to stay away and hold on until that happens. And if it doesn't happen and the market's green, yes, we would have missed out on SoFi, but it's okay because we've got long positions already in our portfolio that we're going to benefit from. So it's kind of a win-win in that sense. So SoFi's on the list. If it does drop back down and get down to this, mid sixes level, I'd be happy to slide back in with a 6-strike put and start the whole process over again. But I think at this level, it's a little too rich for me. Some other options that we could potentially add, I don't know. So let's go to the scanner and see what we can find. Let's go to the option hacker. We're going to start just with the high ROR puts without earnings. So we're going to load that in there. We're going to go to load scan query, personal high ROR puts without earnings. And to get all these scanners preset into your Thinkorswim module, again, hourglass-trader.com. That's one of the benefits of being a premium member, is we share the links to download all of these scanners. And this one right here objectively gives us the highest premium stock, or the highest premium options in the market. So whether you're selling puts or whether you're trying to sell covered calls or whether you're just looking for any sort of option premium in the market, this is a fantastic scan to use because it objectively gives you the most. We've got Fleur67 in the Twitch chat asking about AWF. I'm going to hold that thought. I will get to AWF after this little tangent right here, but appreciate the recommendation in the chat. And if anyone watching this has questions about any stocks from an option selling perspective, or if they have any stocks that they would just like to see analyzed quickly, feel free to throw those in the chat. I definitely want to make this as interactive as possible. But we've got FFIE at the top of the list, and I don't hate that. We actually, at the very end of last week, thanks to our, again, one of our alerts in our Discord server, let me see if I can find it really quickly. Pull this onto the screen, hurry up and load, we're live. We did have another alert about it being halted. There you go, another one of those alerts in our premium Discord alert channels, which let us know that it was a decent potential option selling opportunity. And we sold 1.5 strike puts for 14 cents, which is absurd to think about. And that option price was proven to be pretty absurd as we closed it, I think, within a matter of a few hours for about a third of what we sold it for, resulting in $180 of profit. But again, unsurprising to see it sitting at the top of the list for the coming week. So it's one of those things where I know FFIE is kind of a garbage stock. I'll be the first to tell you that. But when you start to see premium numbers like this, it gets a little bit appetizing. However, what do we know about these former SPACs? Because that's what FFIE is. It's a former SPAC. I think the company is maybe borderline a fraud, but it has a low of 165 off a huge decrease in the stock price, hitting that level of support, which is what happened on Friday. And 2 looks okay. If you did go in on those 2-strike puts, again, you could sell 10 of these. And what's interesting about this is, when you get low enough strike-wise, the position sizes are very, very small, right? Selling 10 2-strike puts is a much smaller position size than selling 10 20-strike puts. You actually kind of get a return profile that looks similar to a spread in a sense, but knowing that you literally would have to have the stock go to 0 by next Friday to hit max loss, which is very, very tough to do. But with that said, if you want like a high-risk, high-reward position, I think these 2-strike puts are it. But at the end of the day, what we do want to remember is that our defense against this is that we take assignment of the stock. Do I want to own this stock? Not necessarily. I think it might be a good one to potentially swing in and out of very quickly. Let me zoom in a little bit here so we could get a better idea of what IV looks like. It's definitely, I don't even know if I would say it's higher than where it normally is. It's still kind of around levels that it's been trading at for the past week, so I don't anticipate these moving too much Monday morning. It's more of a week-long play if you're getting in on these. So high risk, high reward, FFIE 2-strike put. I'm not going to do it, but there you go. The crypto stocks are up here, kind of unsurprisingly as well. We talked a little bit about how crazy of a move Mara had. Let's see. Let's take a look at AWF. And let's see if this thing lets me delete comments because we just got spammed. I guess not. Anyways, please ignore those messages. Taking AWF, let's take a look at it. And I don't know what AWF is, so this is maybe a great lesson in how to research stocks that you don't really know anything about. No options, so we're not huge on it. We typically like to play things with options because it allows for a bunch of flexibility. Let's see. It's definitely in a little bit of a downtrend over the last 180 days, although it did bounce a little bit off 9.5. RSI is sitting at 58. Don't know too much about this, and when we don't know too much about something, we go to the Analyze tab, we go to Fundamentals, we type in AWF. So here we go. And we don't get a description here, which is a little bit annoying. Let's go to Google. Hell, let's do the normal process. Thinkorswim has let us down. AWF. Oh, it's a global high income fund. Okay. Makes sense. So I imagine they're paying a decently high dividend. So if I look up, there we go. Autocomplete right there. Dividend. Quarterly dividend, 8% annual dividend yield is not bad at all. I mean, there's nothing wrong with potentially taking that trade on right there and just having it as something you own. So honestly, AWF, not bad. And we've actually been working a little bit on a dividend portfolio. This is, thanks for suggesting this. This might be a fantastic segue into the little dividend portfolio that we've kind of been building on the side. But we've got four different stocks in here. We've got the S&P 500 ETF, SPY. We've got PHK, which is probably similar to AWF. It's a PIMCO high income fund, and it has like a 10%-ish dividend yield, I believe, which is fantastic. And we've got Good, and we've got Jeppy. Jeppy's another income fund, and I think Good is real estate based. But we definitely want to continue to diversify this and pull together a bucket of really nice dividend stocks. So AWF could be one to keep an eye on and potentially throw into this when we make our next purchase for it in August. The idea is we add a little bit each month. We had a May, June, and July purchase, and we'll do it every month and see how we can grow a nice dividend portfolio, because we do a lot of exciting stuff on the week-to-week basis with some of this option selling. And then it's also fun to have some nice slow growth going in the background as well. You also diversify your risk a little bit so you don't have 100% of your money in an options trading portfolio. But back to the chat, we've got HIMX from Stephen Wolf. Let's take a look at it. I think this ticker definitely rings a bell. HIMX. Himax Technologies, we see a low of 184, a high of 1666, and a current price of $7.06, so kind of right in the middle of all of that. It's a semiconductor solution provider. Interesting. Let's take a look at that chart again and see if we can get a technical idea of what's going on with some things like RSI and implied volatility. And here we go over the last 180 days. Looks like it's fallen a decent bit, and I think just in general that industry with semiconductors has felt a little bit of heat. Implied volatility may be surprisingly lower. If we go to the 1-year chart, we're actually going to get a read on this. IV percentile, yeah, IV rank is 15 and IV percentile is 27. Basically, in plain English, 27% of the days in the past calendar year had lower IV. So it's definitely on the lower side of IV. And we like IV so much because that's what provides option premium. We sell options. Let me actually just make the chat box hidden a little bit so you guys can see some of this. RSI kind of dead in the middle at 43, which is so. We do love RSI because, again, I think we can look at pretty much any chart historically and see that when it goes to the blue, we see a little bit of a bounce, which we did see at 6 back up to 706. Here's another instance when it went to the blue and bounced back up a little bit. Here's an instance when it went into the red and fell big time. So that's why I love RSI as an indicator, and I'm not a huge technical analysis type trader, but I will die on the hill of RSI being an effective short-term bounce indicator. But with that said, let's take a look at the option chain. What we love about this is there's weekly options, one, so a lot of flexibility, a lot of smaller stocks with less volume. You'll only see monthly options, and when it's July 24th and the monthly option expiry isn't until August 19th, that surrenders a little bit of flexibility, which makes it a little tough. However, we've got that's not a problem for us right here. We've got weekly expiry. We've got decent premium right at the money with 2.56%. But it doesn't look like there's too much volume outside of that. But let's walk through the exercise here, right? So it looks like the options themselves are pricing in a decent move. Like the expected move is 42 cents for the coming week. But the market maker move up here, which is TD Ameritrade's proprietary formula that they'll tell you a little mirrors the market makers up in Chicago a little bit more closely, and in theory should be a little bit more accurate. That's sitting at 16 cents, meaning that the low end of the range for the expected market maker move on HIMAX, or HIMAX, however you want to pronounce that, is going to be $6.90, which if you sell this for 20 cents, you're going to have a $6.80 break even, so the numbers do check out there. But I do want to emphasize that on a short-term basis, it was just 10 days ago on July 14th that HIMAX was trading at $6.18 a share. And again, we like that exercise earlier. We did it on SoFi, where if you draw a line on where your break-even is going to be, does it look conceivable that it could break down below that level? And here I would say absolutely. So this is one I think I would stay away from just from a downside perspective. Maybe set an alert to see if it gets back down to 650, because in general, 650, you see it bounce off this level a lot. We've got one bounce. It did break below for a brief moment, but quickly bounced off, bounced off, bounced off, bounced off. 650 is a much better level to play this, and if HIMAX drops back down to 650, I think that's when you pull the trigger on the 6.5 strike puts there. But again, thanks for the suggestion. Always good to have some new stocks on the radar. So back to the scan, going top to bottom, and we've got a video coming out about the intersect with features, so let's quickly use that and scale down some of these results, right? We have this high ROR puts without earnings scan. It has 522 different results on it. We don't have time to go through 522 different options, unfortunately. So this is a way to, have a much more focused scan. So what this is going to do is it's going to intersect these option results with different stock criteria. So if we talked about how we like RSI so much and how RSI is a really good indicator of if a stock is oversold. So we're going to put the HT oversold stock scanner on here as well, meaning that all the results we get right here are going to be oversold stocks. And we've got gold right here, which is ticker GOLD. That one I can pronounce pretty effectively. Ticker GOLD, and this is one that I bring up because I know what it's going to look like. And it's a fantastic intersection of low RSI, higher IV, and decent entry price. So if we go to the 1 year chart where we get that IV rank showing up on the screen again, IV percentile is 87. Remember, we looked at a stock a second ago that was 27, meaning it was relatively low implied volatility. And we have implied volatility plotted by this blue line right here. So relatively high implied volatility, again, that's good for us. High implied volatility means high option premium. And high option premium means that we're going to make a lot of money when we sell these options. So when we combine that with an RSI on a 1 year basis of 24, we are primed for a short-term bounce. Option premium should be nice. And then we take a look at the option chain. Boom, you're going to see it right there. I've got the red position flag right there because I already did this on Friday because I liked the opportunity so much. I sold these 15 strike puts for 25 cents a premium, meaning my break-even price is going to be $14.75. And again, we could run through that 10-day exercise and say that my break-even price is going to be down here. Now notice the difference when we draw the break-even price down here as opposed to something like HIMAX, where again, we could very conceivably break below this price. It had been chilling below that price for a little bit of time. Whereas with gold, that line that we draw for our break-even price, it's decently below where it's been over the last 10 days. So if it gets down to that price, one, we've got a very advantageous cost basis in these shares if we were forced to take assignment. And two, there's some precedent for it bouncing off this level already, so we've got that. You combine that with the fact that RSI is low, and you've got yourself a really nice setup. And if we go to a 3-year view even, I took a look at this, Those pre-COVID lows, that bounce level, it looks like the bottom of the candle wick is high 15, so we're right around that level. So hoping for a short-term bounce on this one, but again, even if we don't get a bounce, all we need to be profitable with this strategy is that it hangs above 15. So as long as it doesn't drop, what's the number? If this thing will hurry up and go to my tab. As long as it doesn't drop 3.78% this week, we're going to make money on it. And if it stays above 15, we're taking home $250 of profit. And again, that's all from just hitting the scan tab, throwing that tab in there, or throwing the scanner in there, and jumping in. There isn't too much behind this. I think having these preset scanners is a really, really important tool in the option seller toolbox for being able to identify these opportunities. Now, understanding the ideas behind option selling, how to manage trades, that comes with experience. That's all equally important. But the starting point, you wouldn't even have a trade if you didn't have a ticker or option idea identified. So really, this is where it all starts. PSNY, we do have two other results on here. PSNY is Polestar, which is a company that just went public with a Gore SPAC. And again, we don't like those SPACs after they go public, so we're going to leave that one alone. WPM is another precious metals company, but when we just talked a little bit about gold and how it was getting down to that pre-COVID support level, WPM is still relatively elevated above those pre-COVID levels, so I think there's a little bit too much downside risk there. And especially when a precious metals company is very similar to a gold company. From a diversity perspective, these are kind of the same position. Let's go with the one with a better setup. Let's sell those gold 15 strike puts. The other thing we can intersect this with is we talked a little bit about IV rank on the 1 year basis. We can pull that chart back up saying that, we like it because it's comparably high when taking a look at the last trading year. We can go to the scanner and intersect with the IV rank scanner, showing us stocks that have high premium, and not just high premium, but premiums that are unusually high when compared to the history over the last trading year of that stock. And we see Unity come up, and again, we see gold come up here. And I think if you see a stock come up on both of these scans, that's kind of a green light to jump in for you. So that's what I did right there. Really big fan of that gold position again. But we've got Unity showing up here, and I really like Unity as well. We do have Unity for the upcoming week, and that gave me a little bit more confidence in holding that position. If we zoom in a little bit here, we see we've got a nice support level at about 32. Let me go back to that 1 year chart again really quickly. RSI is at 45, so it's slightly oversold, but honestly, anything that close to 50, I wouldn't really make anything of it one way or another. But what's most attractive here is the fact that, one, you would have Unity at almost an all-time low, and two, comparably to the last trading year, implied volatility looks really, really nice. So we jumped over here, we sold some 34 strike puts, and I believe we got about $1 for those. Let me check. 92 cents. So we know that our break-even price on Unity is going to be $33.08. So as long as it doesn't drop 9.3% in the coming week, we're going to make money on it. And if it does, I'm fine with that because 33.1 is a solid basis to have. And two, we're not in a full-size position. We can make that break-even even lower, targeting that 32 level that it's been bouncing off of. Another suggestion from Fleur67 in the chat is going to be LIKKF, a lithium mine in Australia for the future. Let me see if KKF brings it up. LLKKF, there we go. No options, it is penny stock type territory. I mean, fundamentally on a 1 year chart, it doesn't look that bad. It's kind of at a support level at 50, decent upside to 2. 3 year time frame, that looks not so good. I would definitely caution you if you're playing a penny stock. I think if the chart looks like this, that's not too bad. You've got somewhat defined downside to this, high 30s, low 40 cent area. But if you back it up to like a 3 year view and you see that the stock's trading for a literal penny, that's a ton of downside. So that is one that I would probably try to stay away from. But with that said, we got SoFi on the shopping list for the coming week. FFIE is going to be a high risk, high reward. But again, how risky can these trades get, right? Worst case scenario, you're taking assignment of it at a very, very favorable basis. But since both of those focused scans, we went through those, we got a good idea with Unity. We got gold. Let's just go back to the general scan here, clear this out really quickly. And again, these are objectively the highest ones. And this doesn't mean that the things at the top of this list are going to be the best ideas. In fact, I typically find the sweet spot to be going down to this 5, 4, 3% range and just looking for tickers that you're potentially familiar with. Because if we start a position, and we like to target a 1% return per week, because a 1% return per week annualizes to a really, really nice number. Now, you could have an entire position set up at a 1% ROR level, or you could start with 1/3 of a position where there's much less risk up front at a 3% ROI, which still has the effect of giving you 1% on a full position, right? Because 100% of a position at 1% ROR is 1% ROR. But likewise, a third of a position at 3% ROR generates the same profit as 1% ROR, while having less at stake off the bat and giving you flexibility to lower that break-even price through the week, yada, yada, yada. But that's why we like scaling into these plays the way that we have with the firm, the way that we potentially plan to, but hope that we don't need to with Unity, and some of the other tickers that we've talked about tonight. We've got Roblox on here, which is interesting. It's at 38. It definitely ran away from us a little bit at the 30 level. I think that's one I would like to keep an eye on. And if it comes back down to 30, then we could potentially get back in. But it ran up a little bit too hard, too fast, and we've seen how quickly it can come back down. So staying away from that one. We see Zim pop up right here. That's where we got that idea from. We have Zoom stock at 106. Not a huge Zoom guy. Actually, one from last week that was kind of interesting was Stitch Fix. That was on our shopping list from last week. Looks like it finished pretty red on Friday again, so potentially decent entry here. And I've done tons of analysis on this, as you could tell. But it looks like it was at 5-ish. We go back to that 180-day chart. Let's see what the all-time low. 466 is the all-time low. So anything in the 5-ish range here, I think it'd be really nice. You got a 1.48% ROR at 5.5. The 6 strike here really isn't the worst thing in the world, right? Because we talk about potentially taking a 1/3 size position at a 3% ROR or better to effectively get the same result as a full size position at 1% ROR. And you can get 4% ROR right here. So maybe a starter at a 6 strike with the 580 break-even price isn't the worst thing in the world. We can go to the 10-day and 580, it definitely cuts right through that number very quickly. And it looks like there's a little ways down to 5. But another one where similar, the conclusion we came to with High Max was that, hey, if it comes back down to 650, seems like a good entry opportunity. I think Stitch Fix may be similar here, where if it comes back down to 550, I like that we've seen a little bit of a bounce and a continuation off of that level, and you're going to be able to get a lower strike at a better price. So definitely want to keep on the list, and if it comes down to 550, I do like that level. So let's put that on the list here, SFIX 5.5, so I don't forget what I just said, and we'll keep moving down that list on the scanner. Let's see, we've got Unity popping up again. Zoom United Airlines may be kind of interesting. Let's keep scrolling, see what we can see. JWN is Nordstrom, and I know for a fact that one has been a little bit lower than where it currently is. DocuSign, kind of interesting to see this high up. I remember seeing that one at the end of last week, but I didn't quite pull the trigger on it. But let's take a look. It looks like 58.79 over the last 10 days. And let's pull up the last month to get a little bit more context. 55.86 over the last month is the low here. Looks like we have a nice bounce off of the 60 level. Let's go to the 1-year chart. And again, you start small and slowly back up to get an idea of what's going on with these stocks. IV percentile is kind of middle of the road, right? It's not nearly as high as it was back at the end of May. Not nearly as high as it was back when it peaked at the beginning of March. But it's up there-ish. And let's, again, back out finally to the 3-year chart to see where it stands relative to before it took off for COVID. And you'll see that pre-COVID peak is 92.77, and the COVID base is actually 60, what's the bottom of this candle? 64.88, which is pretty much right where it is. So I think this is a fantastic potential entry for DocuSign, and this is a decent company. I mean, I see a lot of DocuSign used in the professional world. So I think there's definitely a nice application for it. And, it's not like you're chasing this thing up at 300, which is where it traded back in August of last year, which is insane. Let's take a look at the news. See if there's any price targets. We have a price target down to 54. That's not terribly encouraging. Do we have any other potential price targets in here? It doesn't look like it. We can go to analyze and type in Docu again, because sometimes they'll have little ratings here as well. We have a reduce, 3 stars, hold, neutral to avoid. Let's see if there's any profitability. Let's see. Yeah, negative earnings. Their PE ratio is negative 141. It looks like, I guess they're losing money, interestingly enough. Let's actually take a quick look at the financials here of DocuSign to see if we can get comfortable with the idea of this stock. So if we go to SEC Edgar, that's how you're going to find your company's search link. Pop that in there. We're going to type in Docu as it loads, D-O-C-U. And this is how we're going to find the DocuSign annual and quarterly financials. So let's take a look at the most recent quarter. Pop it in right here. Let's navigate down to the statement of operations. There we go. And this is just for a quarter. If we walk down to net loss, there you go. It's a $27 million net loss. 27,000. Yeah, it's 27 million. 27 million net loss for DocuSign off of about 588 million in revenue, which isn't it's not terrible, but it is a little bit concerning that it's a wider loss than it was similar quarter in 2021. So they're not really growing from that perspective. And these companies that aren't necessarily profitable unless they have a pretty clear path to growth, I'm not the biggest fan of viewing those as a long-term investment, which is what DocuSign would have to be. But we could finish out the exercise here knowing that we've got a nice level at 60 for potential entry, and you're getting that 1.35% ROR. I mean, it's definitely there. You've got a 2.7 market maker move, which will put you down to about 61.80, so that's kind of about the level. And you know, the scaling in strategy would suggest that the best idea here is to enter half a position at 62, which would give you a 60.765-ish break-even price, which would throw you, let me take the news off this chart. That would throw your break-even price right around, come on, here off the bat. And honestly, looking at this now, I don't think this is the worst break-even price in the world, and I think this actually lines up pretty nicely, especially if you're going to potentially take assignment. However, I think this is one that's better suited for the shopping list because we see it's at 63. We've identified there's a little bit of support at the 60 level, and we know that the low is 55. So let's let this one, because we looked at the financials, we know that they're losing money. Not fantastic, but the option premium is nice, so sometimes you could still make a decent trade out of that, but I think it would be chasing a little bit to go after this one at 63.9. So if we kind of put it on our shopping list, if it gets back to 60 or pulls back below that, I think that's a green light for entry on DocuSign. So let's go back to the shopping list and finally add DocuSign to the shopping list at like the 60-ish level. So there we go. We've got 4 names as potential add options for the coming week, and I think Lemonade, LMND, that was also on those scans, definitely an interesting one, because if you go to the 1-year chart on here, you're going to see that their IV percentile, I guess not through the roof or anything like that, but it really is starting to base in this mid to high teens level, and it's another stock that was similarly crushed as the entire market got dragged down. This thing used to trade at $188 a share after IPOing in the 50s, it looked like. So that is absolutely insane. So to get it for below 20 seems fine. But again, this is another loss-making stock, I believe. However, I think much better growth outlook than DocuSign. Because if you think about what DocuSign does, is it essentially makes business easier when you're not in person. It's in that Zoom type of basket where the pandemic was kind of the best case scenario for those companies. So growth as we, slowly and begrudgingly move back to the office might be a little tougher from DocuSign than it might be for something like Lemonade. And a little insider information here on Lemonade, I purchased a $6-ish a month renter's insurance policy through them last week. So I'd imagine their next earnings are going to be pretty impressive. But we can go back to the trade tab. We could see what they're potentially offering. Really, really nice ROR around the money. I'm a decent fan of just the way this one sets up. And we see a little bit of a bounce here at the 1860, 1870-ish level. So potentially we could wait for it to drop back down there, but I don't even know if it's necessary to wait. We see that 17 is the low. I mean, hell, we could sell a 17.5 strike for 2% ROR. A half-size position is what that would dictate in order to get the equivalent 1% ROR. And we'd have a break even of 17.10 right off the bat. And again, if we plot that 17.10 on the chart, that looks pretty good. I don't hate the way that looks at all. We go to the 180-day, we extend that thing to the left. And yeah, I mean, it briefly comes below this level with the amount of premium. And look, this is from April 14th onward. And the range it's trading in, I think this is a fantastic potential opportunity to establish a basis in there. And you look right at the money for this thing, there's like 80 cents of premium at the money. So if you were taking assignment of this stock, you'd be able to knock your basis down by like 60, 70, 80 cents per week. So even if we started at a 17.10, and again, we would start with that at a half size position so we can maybe manage that into the high 16-ish. You would think that after taking assignment and rolling the position, you could kind of get yourself down to the 16-ish level, which is an all-time low for the stock. So I'm a big fan of the way Lemonade sets up here, and if we do up in red, that may be one of the first places I look at that 17.5 strike. So I'm a pretty big fan of that, 17.5, and we'll throw that in there. But that's what we got for the coming week, right? We've talked about the trades that we have set up in our current portfolio, all set to potentially make a base profit of $3,431. We talked about how it is, almost instinctual for us to add a ton of positions during the week, as indicated by these little highlighted purple trades, and those typically go pretty well for us, right? There's $2,000 that week, $2,500 of profit the week after that. So a lot of opportunity intra-week, and with how volatile I expect the market to be with some big names reporting earnings, and with the Federal Reserve announcing the new interest rate hike number, I think there's going to be a lot of opportunity intra-week. I think Monday and Tuesday are going to be red because the last few times before we have, had that Fed announcement, we have seen a red market, which is, just something that's good to keep in the back of our minds. But with that said, I'll be playing things bearishly until then, and then the big events on Wednesday at 2 p.m. Eastern time is when they're going to announce that. So just going to keep an eye on the market day to day as we always do. And if you want to stay tuned with what we're doing and alerts for our trades as we open them, hourglass-trader.com, join HT Premium. Not only will you get alerts for all of the trades we make, which you can see at the HT Trades channel right here, with our profit tally at the end of the week, all the trades we're entering, all the trades we're exiting, but you'll also get access to these channels where you're alerted real time for some of the more time-sensitive stock opportunities. So with that said, that's what we got. We've got our shopping list out to the right, and I think we're set up for another really solid week as we look to close out July and hopefully take home a profit of over $20,000 for the month as we look to extend our lead on the year on the S&P 500 and NASDAQ index, and consequently extend our lead since inception, since we began publicly tracking these trades. And maybe we could be outperforming the S&P 500 by 100% in a couple weeks, but we're sticking with it. For those of you who have stuck with the stream tonight, thanks for watching, thanks for tuning in. And for those of you who are maybe watching the replay, if you made it to the end of the stream replay, thanks for watching as well. But we'll be available in the Discord server all week. We are signing off right now. This has been the Hourglass Trader, where as time passes, we make money. Thanks for watching this week's stream, and hopefully we talk again same time next week with more money in our account than we have right now. Thanks, guys.